Alright, so in this video, we'll go over RA number 8556, also known as the Financing Act of 1998. So essentially, it's the law that governs all the financing companies here in the Philippines, okay? So Section 1 is the title, Financing Company Act of 1998, and then you have Section 2 for the Declaration of Policy. It is hereby declared by to be the policy of the state to regulate and promote the activities of financing and leasing companies to place their operations on a sound, competitive, stable, and efficient basis as other financial institutions, to recognize and strengthen their critical role in providing medium and long-term credit for investments in capital goods and equipment, especially by small and medium enterprises, particularly in the countryside, and to curtail and prevent acts or practices prejudicial to the public interest, so that they may be in a better position to extend efficient service in a fair manner to the general public and to industry, commerce, and agriculture, and thereby more fully contribute to the sound development of the national economy. So it's a lot, but they're saying something really good, right? So again, regulation of financial institutions. So financing companies as a kind of financial institution. So they're dealing with public, and in a way they are affecting the public interest. So they need to be regulated by way of this law and its implementing rules and regulations. So it's also for the benefit of the economic development of the country, to ensure that their operations, their activities are in accordance with the national goals, national objectives with regards to the economic development and growth, right? Section 3, amendments, definition of terms. So we have financing companies, called companies or corporations, except banks, investment houses, savings and loan associations, insurance companies, cooperatives, and other financial institutions organized or operating under other special laws. Okay, so essentially, there are different laws being imposed upon the different types of financial institutions. So if there are specific laws for those other particular financial institutions, then those would apply to them. And then if a financing company or a corporation, a company, it does not fall under those categories, then they would be classified as financing companies, provided primarily organized for the purpose of extending credit facilities to consumers and to industrial, commercial, or agricultural enterprises by direct lending or by discounting or factoring commercial papers or accounts receivable, or by buying and selling contracts, leases, chattel mortgages, and other evidences of indebtedness, or by financial leasing of movable as well as immovable property, all right, like a house, building, cars, vehicles, equipments being used by businesses, all right, or by individuals. Okay, sometimes they also deal with individuals, right? Okay, and then SEC shall mean the Office of the Securities and Exchange Commission of the Philippines. Credit shall mean any loan, mortgage, financial lease, deed of trust, advance or discount, any conditional sales contract, contract to sell or sale, or contract of sale of property or service, either for present or future delivery, under which part of all or the price is payable subsequent to the making of such sale or contract. Any contract, any option, demand, lien, or pledge, or to the other claims against or for the delivery of property or money, any purchase or other acquisition of, or any credit upon the security of, any obligation or claim arising out of the foregoing, and any transaction or series of transactions having similar purpose or effect. So credit, they call this synonymous to loan, borrowing. So essentially, in a sale transaction, if you've already received the good or the service, then you are obligated, you have the obligation to pay for those services or products that you already received. Or if there is a sales contract, contract of sale, things like that. Or if the subject matter has already been delivered, then you are obligated to pay for that product or service, right? Especially if you've accepted it and it's in good condition and you're already using it, right? Or you're already benefiting from the usage of it. Okay, so overall term is credit. Financial leasing, mode of extending credit through a non-cancelable lease contract under which the lessor purchases or acquires, at the instance of the lessee, machinery, equipment, motor vehicles, appliances, business and office machines, and other movable or immovable property in consideration of the periodic payment by the lessee of a fixed amount of money sufficient to amortize at least 70% of the purchase price or acquisition cost, including any incidental expenses and a margin of profit over an obligatory period of not less than 2 years. So let's pause here, right? So you have your financial leasing. Essentially, if a person or a business, normally it's a business, right? They want to acquire any of this machinery, equipment, motor vehicles, appliances, machines, other movable or immovable property, right? But they don't have the money, so they go through a financing company. Okay, so the financing company would pay for the acquisition of the machinery or the equipment, but normally they only pay a portion of it, normally 70%. Okay, the other 30% they want the borrower to pay for it. Okay, that's because of course they also want to make sure that that person has the money, all right? And since he has the money, he has to prove that he has the money, so he has to shoulder the remaining 30%. Okay, so the 70% would be covered by the financial company through a financial leasing. So what happens is, upon the acquisition of that property, since the financing company paid the majority portion of it, 70% compared to the 30% of the borrower, so it would essentially be owned by the financing company, right? And only upon the full payment by the borrower would it be transferred to them for their ownership. Okay, so while the financial lease is still in effect, and while the borrower hasn't yet fully paid the amortization or the whole amount, the balance, so it's going to be owned by the finance company, all right? So it's their property, not yet the property of the borrower. Okay, so it's a lease of some sort. Okay, and then the amortization period, not less than 2 years. Okay, so minimum period is 2 years, during which the lessee, the borrower, has the right to hold and use the leased property. So although essentially it's also a kind of borrowing, right? It's a kind of debt financing. So while the lessee or the borrower is still repaying the balance, so he already has a right to use the property. Okay, and then with the right to expense the lease rentals paid to the lessor and bears the cost of repairs, maintenance, insurance, and preservation thereof. Okay, so essentially we have the lessee is using the property, all right, but it's not yet owned by him, it's still owned by the financing company. But since he's using it for the business, he's not going to record it as his asset. He's just going to record the payments, the lease payments, like we call it lease payments, right? Some sort of rent. But, at the end of the period, essentially they're going to own the property upon full payment, right? Okay, and then any expense related to the repair, maintenance, or other incidental expenses to the property, like insurance, preservation, so that would also be expensed by the lessee or the borrower, but with no obligation or option on his part to purchase the leased property from the owner lessor at the end of the lease contract. Okay, so there are, let's just call them 2 scenarios, right? So it's possible that from the beginning, from their agreement or discussion, the financing company and this borrower, they could have either of the two, right? They could agree that the lessee can purchase the property, at the end of the period upon full payment, or there's also the possibility that this lessee or borrower will not own or will not buy or purchase the leased property at the end of the contract. Okay, so in which case it would still remain the property of the financing company, and at some point maybe they could lease it to some other person upon the termination of the lease contract. Okay, other types of lease. Okay, this type of lease, sorry, let's go back. Financial leasing, right? So what normally happens is that it's the borrower who chooses which property they're going to get. It's possible that the financing company is a subsidiary of a seller or manufacturer of that particular product, right? It's either a vehicle or machinery, okay? And so there is that particular deal. And then at other times, it's also possible that the finance company is not in any way related to the seller of the property. Okay, so in which case, normally in that case, okay, it doesn't always happen, but usually there is going to be an agreement that the borrower would buy that property or would eventually own that property upon full payment of the lease contract. Okay, but normally if the finance company is a subsidiary of the seller or the manufacturer of the leased property, then it's sometimes they do have that particular clause that they could retain ownership of the leased property at the end of the contract. All right. Next, we have a purchase discount, difference between the value of the receivable purchase or credit assigned and the net amount paid by the finance company for such purchases or assignment, exclusive of fees, services, charges, interest, and other charges incident to the extension of credit. Okay. Sometimes, on the part of the businesses, especially if they're extending credit to their customers, so they have accounts receivable, right? Sometimes these accounts receivable, they could sell it to financing companies. Okay, these are receivable, so they haven't collected the money yet from their customers. It's possible that they don't have a collection department or they don't have personnel focusing on the collection, reminding customers to pay their debts, or it's possible that these are new accounts but they are in need of money, so they could go to a financing company to advance the payment. Right? So let's say they have receivables amounting to 100,000, right? They go to a financing company to essentially sell the receivable. So what's going to happen is that the financing company, they're going to purchase it at a discount. They're not going to pay 100,000 for it, right? Because they have incidental costs, collection costs, personnel that are going to follow up on these customers to pay the money to them instead of at the business. And then of course they would have charges. They call it discounting fees, okay? Because essentially it's also possible that they may not be able to collect the full amount because there might be customers who are already insolvent. They do not have the ability to pay the accounts anymore. Okay, so for example, they purchase it at a discount of 10%. So instead of paying the business 100,000, they could only be paying 90,000 for it. Okay, so essentially, because the business has immediate need of cash, they go to the financing company. Okay, and then they could have this purchase discount. Alright, next we have lease rentals, refer to the periodic payments made by the lessee to the lessor under Section 3D above. Okay, so the lessee is the borrower and then the lessor is your financing company. Section 4, grant of authority to SEC. SEC is hereby empowered to enforce the provisions implementing regulations except insofar as the BSP may have supervisory authority under the provisions of RA 7653 with respect to financing companies licensed to perform quasi-banking functions. So essentially, a financing company as a financial institution performing quasi-banking functions, they are also being regulated and monitored by the BSP, all right? And then as a corporation, then they are also being monitored by the SEC, all right? And insofar as the Monetary Board has authority to prescribe financing company rates and charges, okay? So since, again, they are a financial institution, Monetary Board, they're the ones monitoring the economic activities, the needed rate for, interest to either stimulate the economy or to discourage spending by the people. So they could change the rates, either increase them or decrease them. All right, and so the financial institutions, including financing company, would have to abide by the rates and charges that they impose, right? Section 5, limitation and purchase discounts, lease rentals, fees, service, and other charges. So the Monetary Board of the BSP is hereby empowered to prescribe, in consultation with financing companies and the SEC, the maximum rate or rates of purchase discounts, lease rentals, fees, service, and other charges of financing companies, so that it would, be fair to the public, okay, and they would not be usurious or very disadvantageous to the public, okay. And then change, eliminate, or grant exemptions from or suspend the effectivity of such rules whenever warranted by prevailing economic and social conditions, okay. Form of organization and capital requirements. So they shall be organized in the form of stock corporations only. All right. So I think we've mentioned from previous video about financing companies. In the US, they are allowed to be partnerships, corporations, LLCs, but here in the Philippines, they can only be in the form of stock corporations. And then at least 40% of the voting stock of which is owned by citizens of the Philippines. Okay, so 40% minimum Filipino ownership. All right, and then paid up capital not less than 10 million pesos. So again, this was in 1998. Okay, so essentially they probably revised already the prescribed minimum paid up capital, right? Not 10 million pesos. Okay, so we're going to skip this part. And then requirement for registration. So they have to abide by the corporation code, be registered with the SEC, and then they also need to acquire a certificate of authority from the BSP. Okay. All the requirements of existing laws to engage in the business for which the applicant is proposed to be incorporated or organized have been complied with. Okay, and then of course after their registration with the SEC, they still have to abide by the local regulations, get a mayor's permit, register with the BIR, and if they are employing people, then they need to register with SSS, PhilHealth, and Pag-ibig. All right. The organization, direction, and administration, as well as the integrity and responsibility of the organizers and administrators, reasonably assure the protection of the interests of the general public. Okay. Sometimes they also sometimes they could review the people who are applying to open a financing company, just to ensure that these individuals are, they have a certain reputation, they are known to be, let's say, they have exceptional knowledge with regards to financing or in the field of business, so that in a way the BSP would be assured that these people know what they're going to do with the financing company. All right. Okay, and then they have this transitionary provision. We're going to skip that. Rights and powers. They shall have the following powers, in addition to those granted by this Act and by other laws: engage in quasi-banking and money market operations with the prior approval of the BSP. Okay, engage in trust operations subject to the provisions of the General Banking Act upon, again, approval by the BSP. Essentially, all the products and services that they can offer, they might be allowed to offer, they still need to get a prior approval from the BSP. Okay, issue bonds and other capital instruments subject to pertinent rules and regulations of the BSP. Rediscount their paper with government financial institutions subject to relevant laws, rules, and regulations. Participate in special loan or credit programs sponsored by or made available through government financial institutions. Provide foreign currency loans, leases to enterprises who earn foreign currency by exports or other means subject to existing laws and rules and regulations promulgated by the BSP. So sometimes they could also support businesses that are involved in the importation or exportation of their products. So they can also finance those activities, right? Nothing in this section shall be construed as precluding a financing company from performing such services or exercising such powers as may be granted by the Bangko Sentral ng Pilipinas. Okay, anything that has not been mentioned but they could possibly offer, so they just need to consult with the BSP and get their approval, right? Applicability of incentives and exemptions to financial leases. So if, depending on tax rules or the National Internal Revenue Code, if there are tax exemptions or tax benefits offered or afforded to financing companies, then they would be able to enjoy those benefits, right? Parity clause: when providing medium and long-term credit to small and medium enterprises, financing companies shall enjoy such other rights, powers, and benefits and privileges as may be granted by the law or regulation to other non-bank financial institutions when they provide similar credit to such enterprises. Okay, sometimes, the government, they do have these programs. Of course, these financial institutions, they have to protect themselves, right? So sometimes they are reluctant to provide services to small and medium businesses, right? And so the government sometimes provide them with certain subsidies or benefits which they can enjoy if they offer these types of services to small and medium enterprises, provide medium and long-term credit to them, okay? Liability of lessors: financing companies shall not be liable for loss, damage, or injury caused by a motor vehicle, aircraft, vessel, equipment, machinery, or other property leased to a third person or entity, except when the property is operated by the financing company, its employees, or agents at the time of loss, damage, or injury. So you have a financing company, they finance a property, right? And it's being used by the borrower or lessee, okay? If it gets involved in any sort of accident or things like that, then the financing companies would not be held liable if it's caused by the lessee, all right? Except if the financing company or, any employee or personnel or agent at the time is the one that caused the loss, damage, or injury. Okay, section 13, we have the Registry of Financial Lease. So the Register of Deeds shall open and maintain a register of financial leases. As an adjunct to the Chattel Mortgage Registry, some sort of, just a registry for people to check on whether who owns a certain property, right? Said lease register shall contain the following particulars: name or description of property, brand name or name of manufacturer, name of model, year of model or manufacturer, serial number, acquisition cost, name of owner or finance company lessor, name of leasee, date of lease agreement or schedule, date of expiry of lease, and date of entry in the lease registry. I'm just not sure if they still have this today, right? Okay, section 11, renumbered, amended to read as follows: penalty, a fine of not less than 10,000 and not more than 100,000, or imprisonment for not more than 6 months, or both at the discretion of the court, shall be imposed upon, persons, associations, partnerships, or corporations, including the managing officer thereof, that shall, alright, so these are the violations: engage in the business of a financing company without authority from the SEC, okay, so you're not registered, you're not a legit business. Hold themselves out to be financing companies either through advertisement in whatever form, whether it is in its stationery, banner or tarpaulin, commercial paper or other document, or through other representations without authority. Make use of trade or firm name containing the words financing company or leasing company or finance and leasing company or finance and investment company or any other designation that would give the public the impression that it is engaged in the business of a financing company or leasing company as defined in this act without authority. So again, illegitimate business, okay, they don't have the authority, so they don't have the right to use the word or the name in their businesses, because it could be misleading. It's essentially a misrepresentation, so they cannot do that. The violators will be fined or imprisoned. Violate the provisions of this act any officer, employee, or agent of a financing company who shall knowingly and willingly make any statement in any application, report, or document required to be filed under this act, which statement is false or misleading with respect to any material fact. Okay, so for example, in the capital requirement, so they're saying they have this much money paid up, but that's not really the case, then that could be misrepresentation. But of course, nowadays, the SEC would require companies to support their statement about paid up capital with bank statements or bank certifications. Okay. And then overvalue or aid in overvaluing any securities for the purpose of influencing in any way the action of the company on any loan or discounting line. Okay, so it's possible they have a client related to an employee or agent of the financing company, and for it to be approved, they somehow, misrepresented again the information. So that's a violation. Okay, so that would be punished. Okay, any officer, employee, or examiner of the SEC directly charged with the implementation of this act who shall commit, connive, aid, or assist in the commission of acts enumerated under subsections 1 and 2 of this section. Okay, and then you have your effectivity clause, 1998. Alright, so that's it for this video. Again, we've discussed the law governing financing companies here in the Philippines. So that's it for this one. Thanks and bye.